Hey traders, welcome to another episode. Ever wondered what separates a successful trader from someone who keeps getting faked out by the market? It often comes down to this: understanding how order blocks and breaker blocks truly work. Because here's the truth, not every order block holds. Sometimes it fails, and when it does, it transforms into something even more powerful, a breaker block. In this video we're going deep into what order blocks are, and the psychology behind them. The key criteria to identify only the valid order blocks. How to use them as part of a high-probability trading strategy. But that's not all. We'll also break down the exact moment an order block fails and transforms into a breaker block. Why it happens, how do they both work, and how can you use them to trade with smart money instead of against it? And how to capitalize on that shift, so you're trading in alignment with smart money, not chasing after it. If you're serious about improving your trading, stick with us till the end. Everything we discuss in this video can be used for stock trading, Forex and crypto because smart money concepts and price action stay relatively consistent across different assets. If that's something you're interested in, make sure to hit the like button, share, subscribe if you're new. And don't forget to turn on the notification bell so that you don't miss out on new content on financial markets. See you after intro. Welcome back traders. We'll delve deep into the concept of order blocks and understand their precise definitions. Let's get started. An order block is a specific price level or zone where institutional players such as banks, hedge funds, or large financial institutions have placed substantial orders to buy or sell a security. These blocks represent significant levels of supply or demand due to the large volume of orders that can influence price movements. Let's enhance the explanation and integrate a candlestick-based definition of order blocks. An order block in a bearish scenario is the zone marked by the last bullish candle before a sharp and substantial downward movement that results in a valid break of structure. In a bullish scenario, an order block is the area marked by the last bearish candle before a sharp and substantial upward movement that results in a valid break of structure. If you're wondering about the psychology behind order block areas in trading and their impact on market movements, let's delve into that now. Order blocks usually involve large volumes of trades, reflecting the participation of institutional players. They use order blocks to accumulate or distribute large positions without causing significant price disruptions. These areas often coincide with price reversals or significant price moves due to the large orders being executed. So, identifying order blocks can help traders anticipate potential reversal points in the market. Order blocks often act as strong demand or supply levels because they represent areas where significant buying or selling occurred. Traders psychologically view these levels as important, leading to increased activity around these zones. Order blocks often appear in areas where the price has consolidated for a period before a significant move. This consolidation indicates that large orders are being absorbed by the market. Traders watch these areas closely, expecting that price is likely to react strongly due to the high volume of orders. Additionally, order blocks can also provide liquidity to the market. However, when these blocks are tested or broken, it can lead to increased volatility as market participants react to the shifting supply and demand dynamics. Now, let's delve into the process of identifying valid order blocks and examine the different scenarios that may arise when spotting candlestick-based order blocks on the chart. To guide you, we'll outline 4 essential rules that can significantly transform your trading approach. Rule number 1. For an order block to be valid, market inefficiency must be present. This inefficiency often manifests as a gap. This gap creates what is known as a fair value gap or simply FVG, which provides clues that smart money is entering their positions around that zone. Specifically, you might observe a gap between the high of the previous candle and the low of the candle next to it during an aggressive price move. This gap represents unfilled orders, creating a zone of liquidity that the market may later seek to fill those orders. The presence of this inefficiency solidifies the area as a valid order block. In contrast, when there is no inefficiency, the price action appears different. The wicks of the candles take liquidity from each part, leaving no gap in the price. This results in an efficient market where smart money is less likely to participate in that specific move, making the order block invalid. Rule number 2. For an order block to remain valid, it must be unmitigated. But what exactly does this mean? Essentially, when we say an order block is unmitigated, we're talking about a situation where the price has not yet returned to that specific order block to balance the orders that were left there. Imagine that the market creates an imbalance within an order block. This happens when there's a significant shift in buyers, leaving an inefficiency in the price action. As long as the price hasn't revisited this area to mitigate that imbalance, the order block remains valid. Traders can then use this zone as a potential high-probability area for entering trades because there's still unfilled liquidity. However, once the price comes back to the order block and fills that imbalance, this is what we refer to as mitigation. At that point, the orders in that block are considered filled or balanced, and the order block is no longer seen as significant. In other words, it's a one-time opportunity. At this point, you can create your position by placing your stop-loss just below the order block zone. But once the mitigation happens, we no longer see that zone as an area of interest for future trades. The imbalance that made it attractive in the first place is now resolved, so it no longer offers the same potential for market moves. So, keep in mind that a valid order block holds value as long as it remains unmitigated. But once the price returns and balances the orders, it's essentially a one-time use, and that zone loses its significance in future market movements. Rule number 3. The order block should create a breaks of structures or change of characters. In a bullish scenario, imagine the area around an order block. When the price breaks above a previous high following an aggressive move, this indicates a potential continuation in market direction. This break of structure signals that the market is continuing its trend, reinforcing the idea that the order block is influencing the price action. Since the order block has generated a BOS, confirming that the market is respecting this zone, it is considered a valid order block. The break of the previous high in conjunction with the aggressive move further validates the presence and influence of smart money in this area. In a bearish market scenario, when the price aggressively breaks through a previous lower low, it signals a likely continuation of the downtrend. This break of structure confirms that the bearish momentum is intact, indicating that sellers continue to dominate the market. The occurrence of a break of structure in this context indicates that the market recognizes and respects the order block zone, confirming its importance as a significant price level. The combination of a break below the previous low and the subsequent sharp price movement suggests active participation by smart money, reinforcing the idea that institutional players are driving the market downward. Rule number 4. The order block should have taken out liquidity from the market and have liquidity pool to target. In this chart, we see a sharp and substantial price move that creates an inefficiency or simply FVG, leading to a break in market structure. Typically, when there's inefficiency, an order block forms, leaving unfilled orders that the market seeks to fill later. You may enter a trade after the order block zone is mitigated, expecting a reversal since order blocks are key reversal zones, but then you get stopped out. Why does this happen? It's important to understand that not all order blocks are reversal zones. Just because the price mitigates an order block doesn't guarantee a reversal. Often, the market is targeting deeper liquidity or more significant zones beyond the OB, making it crucial to analyze the overall context and structure before jumping in. So, when analyzing an order block zone, it's crucial to look closely and determine whether it has already taken liquidity or if there's still liquidity left to be taken. This distinction can make all the difference in identifying high-probability trade setups. Always ensure you're checking if the liquidity has been fully grabbed before placing your trade. Liquidity is one of the most important factors in market movement. In fact, it's the driving force behind every price action. Without liquidity, the market simply wouldn't move. Identifying and marking liquidity areas is key to trading order blocks with a higher success rate because the market moves primarily to capture liquidity. Join us in our next video as we dive deep into the concept of liquidity in the market. Stay tuned. When we say an order block should have taken out liquidity, it means that for an order block to be considered valid, the price must have first grabbed liquidity from the market. We assess liquidity takeout from two perspectives. First, the candlestick-based liquidity takeout, and second, the market structure-based liquidity takeout. In this scenario, the last bearish candle swept liquidity from the low of the previous candle, triggering an aggressive price movement and creating a market imbalance. This confirms the zone as a valid order block. Conversely, in this second scenario, the last bearish candle does not sweep liquidity from the market, making it invalid as an order block. Now, let's examine several scenarios of structure-based liquidity takeout. In the initial phase of this market structure, price moves down, sweeping liquidity below the previous low. After the liquidity is taken out, the market reverses sharply with a strong bullish move. This upward move breaks the previous high, signaling a potential continuation of the bullish trend. Following this, an order block zone is formed. This is where institutional players are likely to have placed buy orders, leading to the aggressive price movement. After the break of structure, this zone may act as a demand zone, offering a potential entry point for future bullish continuation. Now, let's consider a double bottom market structure in a bullish scenario. When there's a double bottom, buyers typically expect the market to rise and place stop losses below it. However, smart money is aware that many stop losses are sitting below this level. They drive the market down to collect this liquidity, providing the market with the fuel to continue its upward trend. This area becomes an ideal zone to look for an order block. The same concept applies to a double top structure in a bearish scenario. In this case, numerous stop losses are resting above the double top. Once liquidity above the top is cleared, the price often makes a sharp downward move, creating a valid order block zone for short positions. Let's consider the liquidity takeout in the consolidation phase of a bearish market structure like this. During consolidation, the price moves within a range, bouncing between support and resistance levels, indicating a lack of clear direction. Retail traders often place their stop losses at predictable levels, just above resistance or below support. In this phase, the price breaks above the resistance level, collecting buy-side liquidity from the market. After gathering this liquidity, the price sharply reverses, dropping to collect sell-side liquidity below the support level. This movement is typically engineered by institutional players to take out stop losses and gather liquidity before moving the market in the intended direction. Such market manipulation is common and forms part of the institution's strategy. Imagine a valid order block is often formed in this zone. After taking out retail traders on both sides of the consolidation range, the price usually returns to this order block. From there, the market resumes its trend, moving in the intended direction. You can apply the same concept of liquidity grabs and market manipulation to a bullish market structure like this during the manipulation phase by institutions. Lastly, in this chart, the market grabs buy-side liquidity, followed by a sharp, substantial move that breaks the structure. This creates a valid order block, which becomes an area of interest for potential future trades. In a bullish market structure like the one illustrated, a series of higher highs and higher lows form, signaling upward momentum. The market sweeps liquidity below the previous low, then makes a sharp move upward, leaving behind an imbalance before eventually breaking the structure. This creates an order block zone, which is an area of interest for future trades. After the break of structure, the market enters a consolidation phase, where stop losses accumulate above resistance and below support. This phase is often known as the manipulation phase, where institutional traders or smart money manipulate the price to capture liquidity. The market then pushes higher to capture buy-side liquidity, and once liquidity is taken out, smart money drives the price downward to collect sell-side liquidity below the support level. Beneath this support lies an imbalance, where unfilled orders are waiting to be filled. The price moves down, capturing the liquidity and filling those orders. Once the demand zone is mitigated, it becomes a good opportunity to consider entering a long position. This demand zone has already taken out liquidity from the previous low, making it a strong reversal point. However, there is another order block that hasn't cleared any liquidity, which means it is the liquidity. This creates a liquidity pool to target. Since this demand zone has already cleared liquidity from the market and has a liquidity pool to target, it becomes a high probability and a valid order block. This allows you to take a long position by putting your stop loss below this zone, and your target is the liquidity pool. As the price pushes sharply upward again, it leaves behind another order block zone. This order block has already taken out liquidity below the support level during manipulation, making it a potential zone for future trades. But the key question is, does this zone have a liquidity pool to target? Now, looking at the chart, we can identify another order block zone, but this zone hasn't swept any liquidity from the market, which means it is the liquidity. This makes the order block valid and gives it a high probability of success for your trades. You can draw a trend line here with liquidity resting above it. Once the price mitigates this order block zone, you have the opportunity to take another long position, placing your stop loss just below the zone and targeting the liquidity pool above the trend line. This setup enhances the potential for a profitable trade. Let's examine another example on a real chart. As you can see in the chart, the wick of the pin bar sweeps liquidity from the previous low. Once this liquidity is taken out, the price creates two consecutive imbalances in the market, followed by a break of structure. This, in turn, creates an order block zone that can be used for future trade setups. As we know, when a fair value gap or imbalance occurs, it signifies a large number of unfilled orders waiting to be filled. Looking further, the price consolidates for a while and then moves down to fill those unfilled orders. As it does so, the price mitigates the order block zone. At this point, we need to evaluate whether this order block has a liquidity pool to target or not. Upon further analysis, we observe another order block zone. However, this one does not sweep any liquidity from the market, meaning it is the liquidity. As a result, it cannot be considered a valid order block, confirming that there is indeed a liquidity pool to target. So, after the price mitigates the valid order block zone, you can confidently take a long position. Since the order block zone is small, you can consider widening your stop loss to avoid getting stopped out prematurely, and your target is the liquidity pool above the invalid order block zone. Now, let's take a look at another example using the euro versus US dollar. We observe a consolidation phase for a while, after which smart money steps in and manipulates the market. The price moves upward to collect buy-side liquidity above the resistance level and then pushes downward to collect sell-side liquidity below the support level of the consolidation phase. As illustrated in the chart, there's a clear order block zone that has already taken liquidity from below the previous low. After sweeping liquidity, the market creates three consecutive imbalances followed by a break of structure. This makes the order block zone a potential opportunity for a long entry, but before doing so, it's essential to first identify a liquidity pool to target. In this context, we also notice another order block zone, but it hasn't swept any liquidity from the market, meaning it is the liquidity. This creates a liquidity pool for targeting. After the price mitigates the valid order block zone, you can take a long position. Since the order block zone is small, you might consider widening your stop loss to avoid being stopped out, and set your target on the identified liquidity pool. As seen in the chart, the price moves sharply after mitigation, creating another order block zone. This new order block zone has already swept liquidity from the sell side during manipulation and from below the previous low, making it a strong reversal point with high potential for a successful trade. However, to increase the probability of success, you still need a liquidity pool to target. There's another order block zone, but this one hasn't swept any liquidity from the market, which means it is the liquidity. You can draw a trend line here. Above this line, many stop losses or liquidity are resting, giving you a clear target. Once the price mitigates the order block zone, you can confidently take a long position, placing your stop loss below the zone, with your target set on the liquidity pool. You might wonder, do we need another order block for the liquidity pool to target? The answer is no. Liquidity can form in many ways, whether in the form of trend lines above highs, below lows, or even the order block itself. That's why it's crucial to assess whether an order block zone is valid before entering your trades, ensuring you are targeting the right liquidity. Now, let's see how an order block invalidates and turns into a breaker block. If this concept interests you, stick with us till the end, because what you're about to learn could shift the way you look at market structure completely. So let's dive in. A breaker block is a previously failed order block. What does that mean? Imagine a price zone where institutions place their orders, expecting the market to move in a specific direction. But instead of respecting that zone, price breaks through it in the opposite direction. This transformation changes its role, from supply to demand or vice versa. Now, why does this happen? The answer lies in liquidity and institutional activity. When price breaks an order block in the opposite direction, it signals that the big players have shifted their positioning. The previous zone that was expected to act as support or resistance is now used to mitigate losses or add more positions. In essence, it flips its characteristic. So, how do we identify a breaker block? Here's a step-by-step process. First, identify a strong order block that previously influenced price movement. Then watch if the price respects that area or completely breaks through it. If price decisively breaks through the order block in the opposite direction, that zone is now a breaker block. You can wait for the price to retest this breaker block, as it often serves as a new entry point. Here's a pro tip every trader should know. Each time price breaks a supply or demand zone without respecting it, that area flips its role. This simple rule helps in anticipating price movements and making smarter trading decisions. Let's see how this plays out in a real market scenario. Watch closely. Price taps into this order block, but instead of holding, it breaks right through. What happens next? The price pulls back to that same zone before reversing direction. This is a clear indication of a breaker block in action. Have you ever noticed how a demand zone suddenly turns into a supply zone, or vice versa? This shift happens frequently in the market, and understanding why can give you a significant edge. Let's break down this concept in a simple and clear way, including the psychology behind the breaker block. Supply and demand zones are key areas where price reacts strongly. But sometimes, instead of holding, these zones flip. A former demand zone, which buyers once defended, can turn into a supply zone where sellers step in. Similarly, a supply zone can transform into a demand zone when buyers take control. Why does this happen? Well, there are several reasons, including changes in market structure, key price levels from higher time frames, and fundamental events like economic news releases. The same principle applies to order blocks. Order blocks represent areas of institutional interest where significant buying or selling took place. However, just because an order block exists doesn't mean price will always respect it. The market can ignore an order block if it's overvalued, oversold, or if there's a structural shift. A good example of this is when a valid demand order block fails to reject price. Instead of bouncing off it, price breaks through to the downside. This shift turns the demand order block into a supply zone, and this specific type of structure is called a breaker block. So what happens when a breaker block forms? Here's how it works. The market initially moves bullish, breaking a key structural high with inefficiency. This move creates a valid order block in the demand zone, signaling a potential buy opportunity. However, instead of holding, price reverses and closes below the recent low. This shift changes the market structure from bullish to bearish, flipping the demand zone into a supply zone, now known as a breaker block. When price retraces to the breaker block, it's expected to reject from this area and continue pushing downward. This gives traders a new opportunity to enter short positions with confidence. Now let's talk about the psychology behind this move. When the market is bullish, many traders enter long positions at the demand zone, expecting the price to continue higher. But when the market shifts and price breaks below the last low, stop-loss orders of these buyers get triggered. This liquidation fuels bearish momentum. At the same time, smart money traders recognize that this failed demand zone now acts as a strong supply zone. When price retraces to this level, they step in with sell orders, pushing price further down. This is why breaker blocks are so powerful in trading. So, how can you use breaker blocks in your trading strategy? Here's a simple approach. First, identify a bullish break of structure with inefficiency. Mark the demand order block that led to the break. Then watch for a shift in market structure, meaning price closing below the recent low. Once the breaker block forms, wait for the price to retrace back to it. You can then enter a short trade at the breaker block with a stop loss above the zone and target a lower support level. By following these steps, you can increase your probability of catching high-quality trade setups. And there you have it. Now you understand why supply and demand zones flip and how breaker blocks work. Now, we know that a breaker block is a smart money concept that occurs when a demand zone fails, turning into a supply zone or vice versa. As we have discussed earlier, this shift happens after the price breaks below an order block, signaling a change in market structure. Once the price drops through the order block, what was once a strong demand area now becomes a supply area. To understand this concept more in depth, we need to look at the psychology behind trap traders. When the price initially reacts to an order block, buyers enter long trades, expecting a bullish continuation. However, if the market shifts its structure and breaks below the order block, these traders are now trapped. Their stop losses get hit, and many hope the price will return to their break-even point so they can exit without a loss. But here's the catch: when these trap traders close their buy positions at break-even, they effectively create selling pressure. At the same time, new sellers are stepping in, reinforcing the bearish momentum. This stacking of different trading perspectives, trapped buyers looking to exit and retail traders entering shorts, makes the breaker block a high-probability, reliable supply zone. But not all breaker blocks are equally effective. Here are some conditions that make a breaker block more reliable. First, the breaker block is most effective when the price is moving in a strong bullish or bearish trend with minimal pullbacks. Then, if the price ignores key supply or demand zones along its path, it increases the probability of a significant reaction at the breaker block. Lastly, the best breaker blocks occur after a significant shift in market structure, confirming the trend change. Now that we've covered how breaker blocks work, let's walk through a simple trading approach using them. In a bearish market context, start by spotting a strong supply order block, an area where price reacted with significant selling pressure. Next, look for a clean break above this order block, signaling a shift in market structure. Once the break is confirmed, wait for the price to come back and retest that same zone, which now serves as a potential demand area. Before entering a trade, always wait for additional confirmation, like bullish candlestick formations or rejections on a lower time frame. If everything aligns, you can go long, placing your stop loss just below the breaker block and aiming for the next major resistance level as your target. To sum it up, breaker blocks are powerful supply zones that form when demand zones fail. The psychology of trapped traders and retail trader behavior makes these areas high-probability reversal points. Remember to look for strong momentum, market structure shifts, and clear price action confirmation before entering trades. We'll explore the criteria and rules for identifying valid breaker blocks and analyze real trading scenarios that make these zones ideal for executing winning trades. So, if you want to refine your trading strategy and boost your precision, stick around till the end. Rule number 1. Liquidity must be cleared before market structure shift. The first and most important rule for identifying a valid breaker block is that price must first clear an area of buy-side or sell-side liquidity before a market structure shift occurs. Here is a pro tip. Unlike an order block, a breaker block does not require the candle body to close above or below the previous swing high or low. Instead, it simply needs to break through liquidity and then reverse, confirming a shift in market sentiment. Rule number 2. The price must form a valid market structure shift. For a breaker block to be valid, the price must break and close below the breaker block with the body of the candle. A mere wick penetration is not enough. This ensures that the shift is confirmed with conviction rather than just a short-term liquidity grab. Rule number 3. A breaker block is one-time use only. Once a breaker block has been mitigated, it is no longer a valid trading zone. This is because the liquidity in that area has already been taken, traders are no longer trapped there, the smart money has already executed its plan, and the market has likely moved on to a new phase. So we only focus on the first clean test of the breaker block as our ideal trade entry. That's when the probability is highest and smart money interest is still active. That's it, traders. Thanks for watching. If you found this video helpful, give this video a thumbs up, subscribe if you're new, and turn on the notification bell so you don't miss any updates. Drop your feedback, questions, or topics you want us to cover in the comments below. Once again, thanks for your support, and we'll see you in the next episode.